that will be one stock and one space definitely in focus ahead of the big GST meet. So it's an action-packed week, so much happening, and we want to unpack it now with Rajiv Batra, head of Asia and co-head of Global Emerging Markets Equity Strategy at JPMorgan. Rajiv, thank you so much for speaking with us. I'm actually going to start with your take on the GDP numbers which have come in. And do you think that for global investors who've been a little cautious on India, does this sort of tilt the scales a little bit and balance it out?
Thanks for having me back here, Tamanna. So GDP growth, I will say it's a double-edged sword. If you will try to present a positive picture through real GDP number, which has come at a handle of around close to around 7.8% mark over there, people will still grieve around by saying the nominal GDP growth is only 8.8%. So it's a kind of a lens which investors want to see. If you are looking at the real GDP print, definitely it's a good news showing that the macro momentum is coming back into the picture post the monetary easing that has started from November last year onward with CRR cut and now being followed by the fiscal policy making. But yeah, nominal growth mark almost way below the 10.5% kind of a territory has been a concerning factor, and that's what your earnings usually follow, and that is currently being putting doubts on the foreign investors' mind that whether they should look at the real GDP print or they should focus on nominal GDP, which is declining.
Fair points, Rajiv. Good morning. Wonder what you are focusing on, and also because it's a lag indicator, is the outlook ahead as sanguine on the growth front, which can impact the market view. And I can tell you, Rajiv, that when you put out that note of the target of 26,500 to 30,000, the market was divided then. Since then, the 50% tariffs have happened, but the GST cuts have happened. All of that has happened, and the market is still divided. I would love to know which side you are on right now.
I'll still stick with my tone of 26,500 base case to 30,000 bull case. The key things which has happened in India is that in India, we have moved from twin policy tightening zone, which was damn bad for the growth for consecutive last 2 years over there, to a twin policy easing mode. Remember, back in November, we were railing under pressure of both monetary policy tightening also, as well as fiscal policy tightening too. When the December arrived, we saw under the new RBI governor, CRR cut started happening. That followed by 100 basis point of policy rate cut and close to 150 basis point of CRR cut overall. Now we are seeing fiscal policy making is joining the bandwagon too. We have seen some bit amount of fiscal subsidies during the election period, followed by middle class tax rate cut or exemption, which was raised from 300,000 rupee to 1.2 million rupee. And now we are seeing a potential GST tweaks. So that has been the interesting set of economic outcome. We are seeing the twin policy easing, which in a matter of quarter or two starts showing the impact. Think about it. If monetary policy easing single-handedly helped us around reviving some macro data point and this real GDP print, why not when the twin policy easing comes into the picture overall, it may help revive growth faster way. No doubt, there has been an offset from external demand slowdown as well as this tariff-related tension, but it will still keep India's growth above water, where in other parts or other countries, we are seeing growth is under tremendous pressure.
Just on the point of the GST rejig that we're expecting to see, and we know for sure that we're going to a two-rate structure. Now, the only question is about what falls where, is there income, input tax credit, etc. What is the quantum of boost that you expect this to have? Because there is a sort of a mixed view on this. There's one camp who says that this will be the big catalyst and a consumption boost, and there's another that saying that compared to what the tariffs are going to do to businesses, this will only maybe mitigate the risk to some extent. Just wondering how you look at the impact of this GST rejig.
So this week committee meeting will be really important to see how the GST cuts will be given on and how much it will be neutralized by introducing a 40% slab or by giving any compensatory says overall. So the number which we are anticipating should be in the range of 0.4 to 0.6% of the GDP in terms of a benefit. It should come on to people in a direct term when the GST rate get reduced. The indirect benefit, because the rate is reduced, can lead to a higher consumption overall, which could be the material one, because it is not just coming on the back of GST rate cut, it is also coming on the back of liquidity being eased, borrowing rates got lower over there. So it's kind of a double booster you are giving overall. But in terms of how much the final number will look like, we need to look into how this week's GST committee meeting gets concluded, and what are the new measures that is brought down to neutralize the revenue losses that will going to happen.
What's your base thesis of what happens over 18 months per se? Do you believe that, I mean, because the negative is that if the tariffs were to stay on, then that has an impact on some export-oriented sectors, maybe the multiples, etc. Something that a few people have pointed out, right? And parallelly, the thawing of relationships on the eastern side, etc., might open up some markets, might open up some imports of key raw materials, etc., which helps business as well. But combine all of this over an 18-month period and not just over the 6 to 9 month period, what is your thesis there?
No, Neeraj, good question over there. When you bring a longer lens over here, one thing we need to recognize that tariff or no tariff, global growth is expected to slow down. We are forecasting US GDP growth to slow down to 1.5% next year. Similarly, growth in case of China next year expected in the range of around 3.64% only. So in case if global growth is slowing down, my exporters are bent to definitely will be getting impacted due to that one thesis also. In mix, if you are throwing in the higher tariff and uncertainty related to that, then definitely it's somber or much more further. So taking that lens into account, exporters as a big pillar or a contributor to the GDP overall, and also drivers of entire emerging market trade, because when you look from GDP growth perspective in Asia or in emerging market region, since COVID, exporters have been the key driver for growth overall, and that exports got further boosted by fixed investment. Private consumption, or you can say domestic consumption, was funding source towards that. Now suddenly when the external demand is slowing down, tariff uncertainty is coming back into the picture, not just in India, across emerging market, we are seeing people are working to support the private consumption or revive the domestic consumption in economy. So all in all, if we bring everything back on the table per se, it seems like domestic demand over exporter or consumption over capex as a theme will be one can play from an 18-month perspective, and also taking into account the liquidity situation is quite benign outside. And as you go into the next year, if you look at the fiscal deficit of the G3 or G4 countries or monetary policy, even they are on the easing term. Like US is expected to expand their fiscal deficit by 70 basis points under OBBA. China is expected to expand by 40 basis points and Europe by 20 basis points. With monetary policy easing as well as fiscal easing taken into account, lot of dollar liquidity is going to hit emerging market over the 12 to 18-month period, which will be good news for India too.
That was going to be my question, Rajiv, that we've seen what? Over 50,000 crore rupees of selling in July and August alone in India. I mean, does the FPI mood turn at the sign of growth, and the GDP growth has been strong, or is it dependent upon earnings in maybe the second half of the fiscal year, or is it dependent upon geopolitics? It could be a combination of all, but which is the linchpin on which the FPI dollar or the FPI dime will turn on India?
So if we look at last 1 year India performance, where India has driven close to around -5% or -6% kind of a return, and you try to do dissection between currency performance, earning growth contribution, and valuation re-rating or de-rating. So India over the last 1 year has seen 10% de-rating. Earnings contribution has been around 3.5%, and that leads to around 6.5% negative return. But when you look at the broader emerging market or the bigger EM guys, they have enjoyed close to around 11 to 12% P re-rating, whereas the earning growth contribution, the return is only 1.5%. it is significantly lower than what India has done. So what India is rallying under pressure is today higher risk premia due to the trade uncertainty. If trade uncertainty subside and along with them you are offering a higher earnings growth, then India trade will be back in picture. I have said time and again that investors don't come to India for lower valuation. Investor comes to India for sustainable higher earning growth. That was missing for the last 4 to 5 quarters, which is slowly, steadily making a comeback. Just concluded earnings season, we have seen 9% PAT growth. That has come after a long time. If we can build on that and achieve 11 to 12% growth mark, which justify the valuation, that is the PEG ratio of around 1.9x to around 2.2x, then foreign investors will be back in India. So growth, earnings growth particularly, is a paramount importance. And then certainly to enjoy the re-rating, we need to bring down this geopolitical related headlines and uncertainty and make it as a page 3 and page 4 item.
I think we can all safely say that is something that no one can predict and no one knows how it's going to go as far as geopolitical headlines are concerned. Having said that, with earnings looking like they're improving perhaps, and what we're seeing maybe Q2 will continue that momentum, where do you see those pockets of value, Rajiv?
The pockets of value still, I will say broadly, is in financial space, is in the real estate space, in the select commodity-oriented sectors where there's a value overall. But we do anticipate entire domestic set of sectors are going to see a positive earnings momentum because of the policy shift which we have seen, whereas there are going to be still drags overall, and drags are going to come again from IT sector, which is largely being impacted by what is happening on the Gen AI and the end demand in the US, followed by pharma, which have a specific like set of a drug that is getting off patent, impacting them. And then some of the export oriented, which are very small, you can say percentage of the NSE 500 benchmark going to be a drag. But domestic demand oriented, be it your financials, consumer staples, consumer discretionary except auto, followed by your hospitals, material name, which include cement, paints, steel. These are the sectors we anticipate are going to show you a rising earning growth or a positive earnings revision trend also in the coming quarters.
Okay. Now, I'm just wondering if you think the mood will turn favorably on Indian IT as well, Rajiv. How are you looking at it? Because I think this is one space that has everyone divided, sometimes a good day, sometimes a bad day. But apart from the short-term moves, in terms of sustenance and valuations, what is the view that you're forming on the Indian IT pack?
No, usually you need either a quite inexpensive valuation, which we are not there yet in terms of a territory to change the mood. We are still in the marginally below plus 1 standard deviation benchmark around 23 or 24x kind of a P. If we start coming below average mark, then yes, it becomes a value bet and my value investors will start looking that particular space. Or we want conditions to change where we start seeing that external demand is turning pro-growth overall. Gen AI side, some of the efforts are being put from the companies on ground, and they also start becoming a proxy AI play rather than being operating as just a plain vanilla software services companies only. So either of the scenario, if it plays out, then IT sector could make a comeback. But so far, what we are seeing for the last 2 quarters, going into the earnings season, first 1 month prior to that, investor trade into that theme. As soon as the first result get out, people start selling or people start creating short on this particular sector. So it is operating in a trade kind of a zone and hence underperforming my MSCI India or a Nifty benchmark.
Okay. Thank you so much, Rajiv, for speaking with us. Always a pleasure to have you here. There you have it, Rajiv Batra, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JPMorgan.